This is the current federal tax developments for the week of June the 16th, 2019. Current federal tax developments are brought to you this week, as always, by Kaplan Financial Education and by your state society of CPAs. This week, we've got a few things happening, including some significant regulations on HRAs. We actually got two new variants of HRAs now in final regulations. We're also going to talk about the IRS into the faxing of transcripts and sending transcripts to addresses other than the taxpayer's address of record. We have final regulations also that were issued for state tax credit donations, and also a new way to report that credit as a state tax payment for some taxpayers. These were some of the regulations that were issued, or proposed regulations issued last year, to try to shut down some SALT workarounds that also impacted some existing credit programs. So I'll be looking at all of that this week. Well, I'm back on the road again, so I'll be back and moving around this week, heading up to the Northeast, heading actually in the tri-state area. I will actually be in Armonk, New York to tape some material for Kaplan. Then I will follow that up with a day in New Jersey. We will be doing, again, the same course I did last week here in Phoenix, Nexus After Wayfair, Multi-State Taxation of Businesses. We had an interesting conversation in Phoenix last week going over that whole thing. And as you may guess, the sales tax side of that course became the big thing. Well, we're going to repeat that in West Orange on, we repeated it on Wednesday, I should say. That'll be doing that. Then I'll go on Thursday, and we'll talk about the advanced issues with partnership taxation in Shelton, Connecticut. So we're going to be around either of those places in New Jersey or Connecticut. New Jersey is in West Orange because the society is moving, and they're relocating. They're going to still stay in the Roseland area, but for right now, their offices aren't really useful for doing the session. So we'll actually be holding the session over at the Wilshire Grand Hotel, not far away. Connecticut, we will be in the Courtyard by Marriott in Shelton, so you can just sign up, meet us there. Also coming up the following week, I have two courses coming up in the state of Oregon. We'll be doing fringe benefits on June the 27th. And that course, we're probably going to have to talk about these new HRAs there. So we'll have that. And we'll talk about qualified business income or more on June 28th, the 199 CAP-A, all that sort of fun. And all that stuff gets going coming up on the 28th of June. Well, let's start with what the IRS is up to this week. And the first announcement is one that came out on June the 4th. And this was an IRS announcement. It's a reminder of something we'd been told was coming anyway. That is, the IRS has decided that there's one less thing you should be doing with your fax machine, and that is receiving transcripts. So the fax machine is going the way of the dodo. And so our fax machines, you got that in this corner of the office, and I don't know about you, but I have found it's being used less than it's been used in the past. People are using things like secure transfer methods. There's all kinds of reasons why the fax machine is a less than wonderful device. I would love the quality of printouts from that thing. But any event, one less place to get stuff. Faxing and mailing to third parties will end on June the 28th. So the last day coming up here at the end of the month on the 28th of June, that's the last work day in June, will be the last day that the IRS will fax or mail transcripts to third parties. So as we do that day, we're kind of done. We'll finish this thing up. There'll be no more of those transfers. Why is that the case? Well, what's driving this has been security problems. Like it or not, it goes back to an issue we've discussed before. It's a problem of authentication. The methods that we have for proving to the IRS that this is the actual person who is authorizing the actual transfer of this data. And remember, a transcript has a lot of data that could be extraordinarily useful to somebody looking to do things that were a bit nefarious. And the methodologies for ensuring that's true are, just basically non-existent. Now, the catch is they always have been, but in the past, we didn't worry much about that. Now, unfortunately, we get all worked up about doing things electronically online, and we want to tie that down. And somebody finally notices that there's this big gaping hole over here to the side that we've never really worried about. So we are now going to worry about this. We will no longer be able to do this. They do give alternative methods. Who is this going to impact? It will impact tax professionals who work with, especially people that work in the collections area. because they're getting transcripts faxed all the time. You're trying to catch up you're trying to get taxpayers who haven't filed for a number of years, so you're trying to get their data out of the system. It will have some impact there. Tax professionals e-services with the authorizations will allow you to electronically deliver those. The IRS feels comfortable with that, so that will be a method to transfer issues. Also, to be totally honest, the taxpayers can also request them themselves. And the issue there is because, obviously, to be totally honest, we are not solving the authentication problem with these changes. If you look at the methods that are currently going to be available, they fall far short. I'll get that all out of what would really prove the person on the other end of the line is actually who they say they are. And the reason for that is unfortunately somewhat simple. Like it or not, as I've said before, security is always a trade-off. And if the IRS actually lock this down and require everybody to go through the formal proofs that are necessary to get an e-services account or to get the equivalent for the individual taxpayer of the e-services account, you would discover that a lot of people would never be able to use the system, would be unable to. There are still a lot of people that would be upset about being forced to go online. They would believe that's unsafe. As I would say, they are mistaken, to be totally honest. Not mistaken that you can't design an unsafe online system. Oh, yeah, the IRS has managed that one. But mistaken in the theory that the way they've done it for the past 40 years was somehow safe. No, it's been glaringly unsafe. But they're used to it. So they're going to work that way. So that's the issue. So what they're going to do in this case is say, well, we're going to go ahead and send a transcript to the taxpayer based on their phone request. But that transcript is going to go to the address of record for the taxpayer. Now, that's not the best way to stop this because it's not totally clear. How in the world do you stop somebody from changing your address of record with the IRS? I mean, send in a change of address form, and suddenly I can reroute things, assume they're going to pay attention to that because that's the thing they pay attention to. So it's not as if that's a foolproof method. It's also not foolproof if the party who is requesting the transcript and trying to work off with it is a party that also has access to the mail as it comes in to whoever's involved. So another member of your household could theoretically still use this to obtain information, but it's probably better than what we've had before. There also will be systems involved for, allowing lenders to access an electronic system. You will no longer, though, the taxpayers will no longer be able to use the paper forms to request a transcript be sent directly to a third party. In this case, all that can be done is the transcript goes to the taxpayer, who then can forward it to the third party. For most of us in practice, this should sound very, shall we say, something. It's like, yeah, I've heard that before. For instance, yeah, we've always talked about the fact that I can give the client a copy of their tax return, but if they want me to send it to a third party, which your liability carrier will strongly suggest you don't do, there's a lot of reasons, including you just have made it very clear you are aware this tax return is being used for whatever purpose that other party is going to use it for, which can cause liability issues. But if you do it, you have to have very formal permission from the client. But I can always send the return to the client, who then can send it to whoever they want. Same basic issue will be here. So if you've not yet worked things up, if you do work with transcripts constantly, and you've not got e-services set up, it'd be a really good idea to go try to get that going over the next couple of weeks before this becomes final. Otherwise, be aware of these changes. If you do work in an area like in lending where you use these transcripts, hopefully you're now already up on the other system to enable you to get this stuff electronically. Just be aware things are changing. Next up, the rest of today, we're going to talk about final regulations that have been issued by the IRS in two areas. And the first set of final regulations were issued with regard to state tax credits. And this is credits you receive for making a charitable contribution that reduce your state income tax. In many cases, states have put programs together that allow a credit of 70, 80, or 100% of what is given to the charity up to certain limits. And why that became an issue was two reasons. Number one, we now have a cap of $10,000 for deduction on the state and local taxes on Schedule A. Obviously, if I have, let's say I have going to pay total state and local taxes of $15,000, if I could somehow convert 5,000 of that to a charitable contribution, then I'd get the 5,000 charitable, and so I could reduce my state and local tax to 10 grand, get the 5,000 charitable, and actually basically, significantly reduce my federal tax without ever having to take a dollar out of my pocket that wasn't going to leave anyway. So that's part of the problem. Now, why this was an issue, we had a chief counsel advice going back to 2011 that held that when states did this, and this was doing programs that were pretty, a lot of the programs, there are various things that were done for these programs, but some of the best known programs in this area were programs that gave credit for donations to private school tuition groups. Here in Arizona, there's 100% credit offered, which goes well over $2 grand that you can make in total for a contribution to a private school tuition organization. And in fact, if you have an S corporation, you actually can rig it so that you're going to get a virtually unlimited deduction. Well, it's going to be limited to like 80, 90 million or something. If you, it's a win the bet first. It's a win the lottery first in. Get your request for credit in before anybody else when the date comes. But you could go up to those levels. Obviously, with the change in the law, that caused an issue because that way of doing things did not go unnoticed by states that were blue states that were very upset that the new law discriminated against them. So they said, well, we're going to set up the same credits because, by the way, those private school credits were mainly in red states. We're going to set up the same deals they do, except we're going to have it go to things we want it to go to, like, public school education or, healthcare that's being done by the state. And so they set up their programs. Well, this set up a problem for the IRS. And so we had regulations to come out to deal with this. Needless to say, it was interesting watching when these came out. Everybody was complaining, which I suppose means the IRS may have gotten this right. If you manage to upset people in red states, blue states, and on all ends of the political spectrum, you probably did it correctly. And to be totally frank, I happen to think they did do it at least correctly if you believe that we should shut down and not allow this to be a workaround for anybody. Basically, I do not see how the service could have structured this in such a way to have not touched the programs that existed before the Tax Cuts and Jobs Act came into play, had it only impact those after, and secondly, and then allow the states to continue had them before to modify those programs because Arizona modifies these things all the time. And also not somehow lose in court when New Jersey, Connecticut, and New York challenged them on this, saying that that's crazy. The reason you gave why we can't do it here should apply to them. Yeah, the IRS had nowhere to go. This is where things run. So, long story short, the IRS basically rejected calls to make significant changes in the proposed regulations from this past summer. From basically about a year ago. It was at the end of August in 2017 that they released these rules. Those of you who are in states that had these credit programs know that if you made the contribution before the effective date of the program, you got a charitable contribution you still got the charitable contribution even though there was this big tax credit. If you made it afterwards, you had to reduce by this credit. The IRS did not agree. Lots of people asked them in the existing states that they should exempt pre-existing credits. The IRS rejected that in the final regulations. They rejected it, stating that the reasons they gave for why this no longer worked, and they did say straight out in the proposed regs that the old chief counsel advice, they said it two ways. First, they said the old chief counsel advice wasn't binding on anybody anyway, so you weren't supposed to rely on that. But number two, they said, look, that chief counsel advice was from an era where a charitable contribution or a state income tax payment were both deductible. So it didn't really make a difference. Now, that ignores one huge issue from back then that we all knew about here in Arizona, which was if you're subject to AMT, charitable contributions, you still got to deduct those state taxes you didn't. But ignore that little problem. They're saying, well, it's radically different. And yes, at least parts of it now are different. So they said, ignore that old chief counsel advice. And that also is the problem because, and here's the fun part, the first issue that we should exempt pre-existing credits, that's kind of like the red state argument. The blue state argument was, well, you've got this old chief counsel advice that says we ignore state tax benefits and we don't ever take this into account. And they said, well, that should still be true. Nothing changed there. And the IRS rejected that. They said, oh, yes, something has changed. Seriously, with the $10,000 cap, this would obviously be a way to work around the issue very simply, and we're not going to let you do this. So let's review where we stand on this. Right now, if you make a contribution to a charity and you get a credit from the state that reduces your income or property taxes by, that's at more than 15% of the amount of the contribution, then you have to reduce the contribution by the credit given to you by the state. So if you make $1,000 contribution to one of these organizations that you're going to get a credit for, the state gives you a 70% credit or $700. Then you have to reduce the $1,000 by $700. Okay, so that would get you a $300 deduction. If they are 15% or less, then you don't need to do the reduction. Now, there is an anti-abuse provision in here. If the state decides we'll get around this, you make a $1,000 contribution to our charity, and we will give you a state tax deduction equal to 20 times that. Let's assume you had a 5% tax rate. So that would make it effectively the same thing. There is an anti-abuse that says, and they haven't yet given us the mechanics of how to work this out, but if you do get a deduction in excess of the amount of, the fair value for state purposes of what you gave, that we have to go recognize that value as well. I suppose the way the reg reads right now, you would have to figure out the reduction in state taxes you are going to get from that contribution, and then you'd have to reduce the contribution on the federal side by that, which would set up a somewhat circular calculation in many cases, but have at it. It'll be fun. They did make one change that was requested by people in states that had pre-existing credits, and this one is one that occurred to me right off too. It seems to make sense. They said, okay, the old CCA, which you told us you're rejecting, you said, well, the difference is now you can't deduct, you can deduct charitable contributions without limit, but you can't deduct the state income taxes without limit because state and local taxes are in the mix. Well, they said, well, what if somebody made this contribution, they itemized their deductions, and they didn't have more than $10,000 of state and local taxes? So I have $8,000 of state and local taxes that I paid. I then make a $1,000 contribution. I get the full $1,000 credit. Well, what's really happened is I kind of just raised my taxes, didn't I? Because presume that I back off my estimates for Arizona purposes and only pay $7,000 in, or I back off my withholding. Well, now I'm going to have $1,000 more taxable income because I made this $1,000 contribution. So what the IRS has allowed us to do, and this is found in the guidance, in notice 2019-12, and by the way, I didn't give this to start. It was Treasury Decision 9864, where the final regs are found here on, and this was issued on June the 11th. In notice 2019-12, the IRS said effectively, if you had state and local taxes below 10 grand, right, on Schedule A, and you itemized, and you made one of these state tax credit contributions that require you to reduce the contribution, you can treat the amount you reduced your contribution by as an additional payment of state taxes. Now, there are some rules here. You only get to count that at the time it's actually applied against state taxes. So let's say you made a $1,000 contribution here to a credit in Arizona, but you only had $800 tax liability before the credit. So you'd only apply $800 against your tax under the rules in this state to that $200 carry forward, where you get the $800 on your 19 return, but the $200 would have to wait until 2020. We see if it would reduce your Arizona tax that year. They also said it would count if you can carry it back 1 year, then they also would count for carried back to one prior year. That's part of this notice. What the notice really tells us is they're going to modify the regulations for state and local tax deductions. And after that modification is in place, then we will go ahead and have this revised structure. So the bottom line is the IRS expects that they will be issuing some new and revised regulations here under Section 164, amending actually Reg 1.164-3. Now, they also told us officially, too, these particular reduce the credit rules do apply if you have an estate or trust and you have a charitable contribution that's deductible under 642C, or put it more simply, what you end up on Schedule A on Form 1041. You remember there's all those special rules to allow for a charitable contribution for an estate or trust. If you meet those rules, and we're covered by that, then and only then we're allowed to, if you have those, we're allowed the deduction. Well, you still got to do the reduction in that case. It didn't tell us about 2019-12 and whether that would count. I would assume you could still try the 2019-12 increase the deduction. Not clear. It really didn't say that. So that could be an interesting problem as we move forward. Let's go forward then to the new HRAs. The IRS issued final regulations TD 9867, issued on June the 13th. These final regulations were issued by the IRS, Department of Labor, and Department of Health and Human Services. And what these regs do is effectively create two brand new categories of HRAs. And they're both categories of HRAs to deal with issues that have arisen under the Patient Protection and Affordable Care Act. We're going to have first an HRA that's called an individual coverage HRA. Okay, and we'll talk about what that is. We'll also have the second type called an accepted benefits HRA. Now, an individual coverage HRA, what it allows, a company is allowed, and you got to meet certain criteria. These regulations go on for well over 450 pages. So it's not a short read. There are a lot of rules. Now, most of what you see in that 450 plus pages are parts of the preamble and the analysis of the impact from OMB. So there's lots of discussion based on comments received on the regs. The regs themselves are not nearly that long. But what it will allow us to do is integrate an HRA with insurance that's acquired outside of the group market, and to do so without having to meet the QSE HRA rules that Congress passed back in the Cures Act. So it's going to be a much more flexible method than QSE HRAs were. So effectively, what you can do in this case, if you have an individual coverage HRA program, you're allowed to integrate that with a policy that's not a group insurance policy. Now, the key issue here is these have to be a policy, not a group policy. One of the factors that comes up in this as they discuss these issues, if you are trying to pay for coverage, let's say your spouse has coverage with an employer, and that employer allows your spouse to add you to the policy, but if you do so, you have to pay the difference. You can't use it to pay for that. That's a group policy. That's not covered by this. They noted that employers always could have just paid that because that was group, that wasn't a problem. This is purely individual policy, so it can't work for this point. And here's the catch. You don't have to offer individual coverage HRAs to everyone, but you have to offer it to specified classes of employees, and the regulations have what classes you're allowed to make. And it is not just whatever you'd select. There is a very detailed list of what's an okay class. And the other catch is inside that class, you cannot offer those people a standard group health insurance policy. Either everybody in the class gets a standard group health insurance policy offering, or everybody in the class gets a individual coverage HRA. But you cannot offer them a choice between the two. The individual coverage HRA can pay for the insurance that you're using to integrate with. So for instance, if I have an individual coverage HRA, my employees could go out, get private insurance, come back in, submit that to me to be reimbursed, or have me actually pay it directly. And that would work as a allowable reimbursable expense under a private coverage, under an individual coverage HRA. So the programs are allowed for that. The idea being that this essentially allows employers to go back to an old 61-146, I remember my old revenue ruling, where we have that reimbursing private insurance policies that's allowed, but under restrictions. Right? We still have restrictions. They're just not as much. Now, as I already said, under these regulations, we have rules for what are permitted grouping. And our groupings are things like full-time employees, part-time employees, seasonal employees, employees covered by a collective bargaining agreement, employees having satisfied their waiting period, employees who are non-resident aliens, employees whose primary site of employment is in the same rating area, like normally the same state, but sometimes subparts of states. You can have salaried and non-salaried employees, and individuals that are hired, by a temporary employment agency. So we can kind of have those, various categories. You can also combine the categories, but if you combine the categories, then we run into these minimum group size rules, okay? And it's interesting. Some things can be done, like you combine waiting period with any of those groups and you're fine. So I could offer to any size group, I can say people who are haven't yet met the waiting period for enrolling in my group health plan and are full-time employees, will get the healthcare HRA. I'll pay for their health insurance. That's a permissible group regardless of size. However, in most cases, you have to meet the minimum size rule. Now, the minimum size rule was put in place in order to help prevent, shall we say, people from like carving out, the high risk people. Exactly. It's like we need a big enough group to make sure we're not trying to write this to come up with a group that just perfectly covers Harry, who we know has a pre-existing condition and is driving up our costs for our policy if we're outside the small group realm. Small groups are all supposed to be weighted generally, but if you're outside that group, having bad risks does impact the premiums you pay for group coverage. So you might try to do this. So your applicable class size minimum goes on how many employees you have. And these are employees you expect to employ as of the first day of the plan year. Any group subject to minimum size rules has to have at least 10 members. So if you don't have 10 members, you've already violated it. And that's only the limit if you have fewer than 100 employees. If you have 100, 200 employees, it's 10% of employees rounded down. So let's say I have 128 employees. I would have to have at least 12 employees in a group. If I got to 131, I'd have to have 13 in a group. That'd be a minimum number. And once we get above 200 employees, you have to have 20. So you max out at 20. So somewhere between 10 and 20. And again, if you're not in the magic 100, 200 employee range, then it's going to be either 10 or 20. It's going to be your number. And that has to be the minimum group size. If you do subdivide, like saying, well, I'm going to have full-time employees who are, whatever other thing you want to say here, maybe, who are subject to a collective bargaining agreement as my minimum group. Well, that's going to be requiring to meet the minimum group size test because you have that pairing in that realm. Okay. One other key thing. Now, if you do this, you have to substantiate that the employee has coverage twice. There are two different times you're forced to substantiate. At least annually, you have to obtain substantiation from the employee that they have qualifying coverage. The IRS has issued on their website an example of this sort of substantiation statement we're to get from the employees. We have to get it before the beginning of each year. We have to have it before we start, their coverage under the HRA. There are special rules if you bring somebody on during the year as to when you have to get it from them. Generally for them, it's before you start coverage. Otherwise, it's earlier in the year when you have to get the annual statement. But then you also have to have on your request for reimbursement, you have to have the employees on that one also say that at the time they incurred this medical cost, they had qualifying individual coverage. If they ever cease to have that, it's tough luck. They're done. You can't reimburse it. So you have to have that for each payment as well. The IRS, Department of Labor and Health and Human Services also have an example of what would satisfy that requirement. That's also on the IRS website on the page they have for HRAs. So you can go look at that. We have it linked in our materials for this week. If you take a look, which is going to be a longer than normal current federal tax update, current federal tax developments, I should say, PDF, but we have that in there as well, so you can get that particular details. Every year, you must offer the employees a right to opt out of this. Why? Because you're going to have to let them know information to see maybe if it'd be better for them to say, I don't want this HRA. I want to go to the exchange and get the credits because I'm going to be a lot better off with the program and the credits than I'd be by taking your HRA, because maybe your HRA is limited and it would only pay for maybe half of the premium. But if I go to the exchange, I can get a credit to offset 95% of the premium. Well, I'd rather go to the exchange. So they have that option. Because of that, there's a written notice to participants you must make. There's another example of some portions of this disclosure that's also available on the IRS website. Now, these programs take effect, you can't start one until years beginning on or after January 1st of 2020. So yeah, don't go out and do this right now. Now, the second class of HRAs we have, and again, under the same rules, the same regulations, TD 9867, are what's called accepted benefit HRAs. Now, this gets confusing because we've already had a type of HRA that could be integrated, with coverage that you could offer and didn't have to meet the market requirements, right? Which is unlimited. You couldn't limit the amounts. You couldn't limit the payments lifetime or in the current year. And that was called an HRA that only pays for accepted benefits. An HRA that only pays for accepted benefits is not it's not the same thing as an accepted benefit HRA. Again, not confusing at all. I'm sure nobody will ever mix those two things up to try to figure out what exactly is going on. Okay. But what this is, an accepted benefit HRA is itself an accepted benefit. While the other side is it's a standard old HRA, but it's limited to paying only things that are being identified as accepted benefits. And you're way deep in the Affordable Care Act if you understand the difference in those two. But if you're going to set one of these up, you need to understand the difference, right? The key catch is paying for medical insurance premiums is not an accepted benefit. So an HRA that could be offered by the employer that was the old style one, that HRA could not pay for insurance. The accepted benefit HRA can pay for insurance in some cases. It just can't pay for insurance that's comprehensive with some various things, but it could pay for COBRA. It could pay for various other things. There are special cases it can pay. The rules are pretty simple. And what they say, in this particular case, you have to, because it has to be not an integral part of the employer's plan. That's a key requirement for this. So to meet that requirement, you must offer an accepted benefit HRA only with people that are also receiving an offer to acquire traditional group health insurance. Now, what that means is that you can't offer an accepted benefit HRA to individuals who are being offered a individual coverage HSA. Got that down? But you could offer those individual coverage HSA people, or should individual coverage HRA. See, I mix those two up all the time, and I've got them mixed up on the slide if you're watching the video. The HRA, but you could offer somebody with individual coverage HRA, you could offer them an HRA that only pays for accepted benefits. Okay, so interesting quirk. But yeah, you can't do both for the obvious reason. Now, the other quirk with this category of accepted benefit HRAs is they are limited to no more than $1,800 per year. It will be adjusted for inflation. These also take effect years beginning January 1st, 2020 or later. That's how the offer go. I'm not sure I'm really too much into this one as to why, but it is being offered. It is a minor benefit. It's considered an accepted benefit in and of itself. So it can pay for a few more things than HRAs. To pay only for accepted benefits. But you remember, you can't combine this new accepted benefit HRA with the other new HRA which is the individual coverage HRA. You have to keep the two separate. So let's talk about where all this comes from. Now, for me, the far more exciting one of these two is the individual coverage HRA. And to be totally honest, I see almost no reason to have a QSE HRA any longer. Remember, that was what was established a couple of years ago by Congress to allow small employers to pay up to certain caps amounts for private insurance coverage. The catch is, unlike the QSE HRA, the individual coverage HRA has no limits on how much the employer can pay for the premiums. So, that's basically what they're going to be used for primarily. Everybody assumes that most of these will be used to pay for private health insurance. That's not a group plan. So there's no limits on the amount. So unlike those caps we faced under QSE HRA that in many cases wasn't enough to pay for the insurance, now there is no limits on the amount. There's also fewer rules in this area. And it's not like there are no rules, still rules, but the rules are much fewer, right? It is effective for years beginning January 1st, 2020. Unfortunately, it doesn't give us a lot of time to plan to see if a client's going to want to go down this route. But what it does, basically, here's kind of how I view it for most clients I would work with, which are small and medium-sized clients, is, if you've been using a QSE HRA, definitely take a look at this. If you have somebody who wanted to reimburse their employees for private coverage, but has been backed off that because the QSE HRA wasn't enough, or they've been short, it didn't work for various reasons, you probably want to take a look at this new option, because this new option is going to be far more flexible. But if you've already got group coverage in place, I don't know if it's going to be worth the mess of trying to break down and put your employees in the proper classes and then check the minimum coverage numbers if you try to do the combinations. I think things can get awfully messy there awfully quick, and I don't know if the benefit's going to outweigh the cost in many cases if you try to set them up that way. So, I think a lot of organizations will probably either go entirely individual coverage HRA, or they'll have no individual coverage HRAs. I doubt that we're going to see a whole lot of things happen the other way, but that's just my take on how I expect this to work. This has been the week we do the updates. And as a reminder, we've got lots of CPE coming up. I've already told you I've got 4 classes that are available for you in 3 different state societies over the next 2 weeks, so you can sign up and watch for those. If we do get a Secure Act, I'm working on trying to get us a course somewhere, right, that we could work on in the other periods. So, we could do that shortly after that comes out. The Secure Act is still kind of hung up. Just one other piece of news for those who are not aware, the Congress did pass the IRS Reform Act that will make some changes in Independent Office of Appeals. That has gone to the president as of this moment. I've not heard that he signed it. We believe he will, but he hadn't signed it as of yet. So that bill, that one doesn't have enough for me to feel like I could really do a continuing education session on it. But Secure definitely has enough if that passes. We already know what's in it. Assuming it passes as is, I'm pretty much ready to go. But we're not going with it until we actually have a law. So keep an eye out for that. But also check your state societies for the other CPE that we have offering. We have various things coming up. As always, we post every week the updates on the website, currentfederaltaxdevelopments.com. You can go there, read the updates as we post them as things happen. If you have any questions or comments, you can send them to me, edzollers@currentfederaltaxdevelopments.com. You can follow me on Twitter. There you can find me. The handle there is @edzollers. I also follow discussions on Reddit. There you can go to the /r/taxpros list. By the way, this week, one of the questions posed there was, how do you file a 13,500 page paper amended return? That's an interesting problem to have, but like boxes, I think is how you do it. It's a much better way to handle it. We do things like that. You can also find me. I will check in every so often on the Connect site, for the New Jersey, Arizona, Minnesota societies. I also check on Tax Talk, Cal CPA's group that's online on Yahoo Groups. So you can check in there, see, if you want to check in there. Tax Talk is open to any CPA anywhere in the country. The Connect groups are open only to members of those societies. So if you're in those societies, you can check in. And obviously, Reddit's available to everybody too, Tax Pros. And I should mention there, they do a really good job of getting rid of the people getting on there who are not tax pros and looking for free advice, figuring that that's what this must mean. No, the moderators are pretty good at getting rid of those posts. So it is nicely cleaned up that way. So if you tried other things online and discovered you had all these people checking in who are just trying to get free advice, that's not what you're going to find there. So we'll check in next week. We'll see what happens. See if Congress does anything else as we're heading to the 4th of July resource. So we'll see if they actually get the Secure Act out before that. Not too sure. But if not, we'll see what else happens. We'll check in. The IRS is doing lots of reg publishing. They actually also put out, I didn't go through these because I certainly didn't have time to go look at those. Late Friday afternoon, they put out a whole bunch of new final and proposed regs on GILTI. So if you're into GILTI, which we're probably not going to cover in any depth on this particular program, but if you're into GILTI, there's like another 500 pages of regs to read there. So more fun. We'll take a look, see if the service issues more regs in the next week, and if they do, what's in them and maybe what you should be concerned about as we continue to follow current federal tax development.